Hello everyone, I'm Marion Leslie, Head of Financial Information and member of the Executive Board at SIX. Thank you for joining me online in this virtual environment, this blend of home and work that defines what we've come to refer to as the new normal. Clearly, a year ago, none of us would have expected to interact so often through video calls and virtual trade shows. But it is this very adaptability that has so very rapidly shaped our new version of society. Before I go any further, I'd like to touch on what this new normal looks like and what it could mean for our industry. In many ways, the industry trends are as they ever were, but they're just more aggressive and more accentuated. At the same time as trying to adjust to new ways of working in response to the pandemic, financial institutions are seeking out new information to make more informed decisions and seek growth. And firms grapple with regulation and governance in cloud-based environments and skills shortages in data science against a backdrop of urgency in digitization, for example. We will look at the role of data organizations in all of this later. Our previous economic norms are not going to return anytime soon. A time when QE was a last resort and a rise in interest rates immediately triggered more overseas investment belongs to another era. Ultra-low interest rates, aggressive central bank monetary supply, ongoing geopolitical uncertainty, and seismic technological and environmental shifts signal anything but a move to more conventional times. In a self-imposed economic crisis triggered by a health crisis, we do not have pattern recognition. Predictions of recovery oscillate wildly and verge on the pointless as events change the situation day to day. In a world littered with contradiction, we've seen circuit breakers kick in across stock exchanges as volatility reaches unprecedented levels, and within weeks of that, the S&P 500 recording its best August since 1986. After a lull, we see M&A is back as markets defy the constraints of virtual working, and the fintech sector continues to consolidate and data firms continue to outperform their peers and the market. Against this backdrop, we believe that the new normal means that it's what you do today, or even what you don't do today, that will define who you are as a financial institution tomorrow. As financial institutions navigate through this new normal, they look for new ways to drive opportunities for growth, whilst relying on today's norms and reference points to provide the stability, clarity, and certainty. We believe that the future of finance is now. One could say that the financial institution is facing its Tesla moment. A firm that started from scratch 10 years ago is now all ascending in the car industry, leaving the well-established traditional players to play catch-up. In this sector, we know the future for cars is not with petrol. The question is, how fast will the industry adapt? The future is here before we've even started to live it. Similarly, in financial markets, the question is not one of what role alternative data can play, it's one of who can adopt the right data strategy the fastest in order to realise the advantage. It's not if, it's when and how. Any institution continuing to slowly add more data to their stack in the traditional way is going to be the financial equivalent of a traditional car manufacturer. The business will not be taken by traditional competitors, it will be captured by the big technology giants of the world. These firms are not weighed down by legacy infrastructure, and they don't have to retrofit everything as they build from scratch. And witness the corporate winners in the pandemic, it's primarily the tech companies. But before I delve further into the future of finance, let me give you a quick introduction to SIX, who we are and what we do. SIX is the third largest stock exchange in Europe by revenue, following the acquisition of BME earlier this year. In the first half of 2020, SIX had a trading turnover of over 1 trillion Swiss francs, nearly 50% higher than the same period in 2019. Over 50% growth in trading turnover of structured products and warrants, and 25% growth in trading turnover of ETFs. But that's not all. We're also the official SARON administrator for the Swiss National Bank, which puts us at the very heart of benchmark reform. We're the official operator of the ANA Service Bureau and one of the founding members of the Derivatives Service Bureau. The world's leading international clearing and settlement house for the 5th consecutive year, and winners of the Waters Technology Award for the Best Corporate Actions Data Provider for the 11th straight year. Processing over 650 million transactions via our SIC payment system and over 1 billion ATM and card transactions every year. In a great example of future meets present, we manage ATMs whilst at the same time leading the way in digitisation and blockchain technology. We launched the SIX Digital Exchange and Central Securities Depository for Digital Assets in September last year. At SIX, we're developing the new at the same time as supporting the old. We're living that contradiction of business model. Our future of finance is now. And it is this challenge, this contradiction and dual business model that preoccupies many a C-suite. With the health crisis affecting every aspect of life, questions are being raised over the future of businesses and more traditional working practices. Until 2020, outsourcing suppliers were not evaluated on their access to health systems or their working from home capabilities. Add to this the prolonged period of geopolitical and economic uncertainty. Add a sharp rise in the focus on sustainability, which in turn is shifting the corporate purpose of financial institutions, as well as regulatory interest, as, for example, the EU pours investment into meeting climate goals. These profound structural changes and drivers mean the industry is at a critical juncture. The business models underpinning all sections of the market are fundamentally changing before our eyes, due to uncertainty surrounding the outcome of the Brexit trade talks and an unpredictable US election. As a result, financial institutions are challenged with defining the real business risks in the short, medium and long term. Forecasting has become next to impossible. Just look at the airline industry having to react to changing quarantine rules. Sustained pressure from ultra-low and in some cases negative rates, as well as increasingly aggressive central bank monetary supply, is completely shifting the tectonic plates of the global economy and creating revenue shortages for banks. Market participants are demanding greater reliability and stability from their market infrastructure. Something has to be consistent in the face of all this unpredictability. Continuous regulatory change from MiFID II to CSDR and SFTR, as well as ever-changing trade sanctions. The challenge for compliance is one of reactivity and flexibility. Digital strategies have become about more than satisfying goals for efficiency and automation. They're now about business survival. The digitization of the customer experience and the employee workflow has accelerated over recent months. In some quarters, COVID is held to be the biggest catalyst of company digitization programs. Just look at the stock price of DocuSign. ESG investing has quadrupled over the past decade, but unfortunately precision, objectivity and methodology remain a challenge. Regulation is pending and the market is still evolving. With the adoption of alternative data on the rise, financial services firms are rushing to get their hands on new data sources to help inform their investment decisions, manage their risk, and serve their clients better. The future of finance is now, yet the pace of change remains slow for many, and this creates a vacuum waiting to be filled. Traditional institutions need to find a way to adapt. There are no prizes for being last in the race for alpha. Fintechs may have the answer, yet they too need help with adoption. They lack the client base, the supplier credentials, and the data required to be successful, and they cannot do it on their own. Growth will come from finding alpha, cracking the customer experience, and effective risk management. Effective leadership, employee engagement, and a more sustainable approach are going to be key enablers of this. So what role does data play in all of this? My conversations with financial market participants tell me that the biggest enabler to digitization, data science, analytics, and risk management is good quality data. Standards are key. Quality, consistency, good reference data, and data models make or break any of these strategies. Corporate actions, reference data, pricing data, good quality and coverage impact the relative security of decisions made in day-to-day risk management with potential impact at board level. If we look at AI and ML and the processing of data, understanding the nature of data and the hidden bias is critical. Quality is more important than ever. Data consumed point to point for a single workflow or purpose carries less risk of large-scale quality-induced issues than data powering an entire organisation's applications from a single master reference database. We've known this for some time. But now consider the exponential impact of incorrect data feeding AI or ML. And what better case study for the financial sector to learn from than the recent debacle in the UK education system, where an algorithm sought to replace the results normally produced by students sitting exams. The mistake was essentially driven by the algorithm not fully accounting for bias. What might have made sense on a macro scale, delivering the right bell curve overall, did not make sense for the individual. Or consider Amazon aborting the use of algorithms to process CVs. The algorithm learned to build bias into its process. It did an even better job of replicating unconscious bias than the humans did. So what do blunders on this social scale tell us about the role of the human and the expert? The balance between the algo and the human has yet to be found, and society will take time to work this out. Pragmatism, expertise, and professional judgment remain critical to a business. Data governance extends its reach when it comes to alternative data, and high-quality data remains top of the agenda, and the need for complete reference data coverage remains paramount. Alternative data is only useful if you can connect it to your securities of interest, your portfolio, or your assets under management. In adopting new data sets and technologies, a financial institution has to be grounded in high-quality data governance, excellent reference data, and increasingly, a large dose of common sense. Here are what we see as the main industry challenges around managing core reference data right now. We all said cloud and digitization were going to change our industry, and they unquestionably have. However, it's not how cloud and digitization has happened that has changed. It is the recent speed of adoption that has changed, and most notably due to COVID-19. Everything from the percentage increase in electronic versus manual transactions in the retail space to the increased electronification of trading in wholesale finance, the pandemic has accelerated the speed of change dramatically. Equally, the digital experience for customers has changed. One can only imagine the percentage increase in the use of DocuSign over the last 6 months. Zoom adoption sent the firm's share price skyrocketing. And from being important, all these issues are now super important. Overnight, digitizing the employee experience became a question of business survival, not a nice to have. And the contract between employees and their firms has changed in terms of the level of trust and the way business is done. Business continuity plans were exposed. Basic assumptions that somewhere in the world an office would be open and able to take on the work proved fundamentally wrong. Some had never imagined that everyone would need to work from home all at once or for more than a short period. And all of this has changed the urgency behind the fundamental drivers of trends that, frankly, are not new. They're just as valid as they were before, but we're looking at them with fresh eyes. Moving CapEx to OpEx can help financial institutions become more agile and drive efficiency savings, and it also increases the transparency between finance and IT. Automation is the holy grail of efficiency, but can be elusive with piecemeal actions across many institutions, whether we look at compliance or customer onboarding. A focus on core activities, continuously evaluating the need to continue to do something in-house, enables organisations to optimise their operational activities and costs. Data is key to digital transformation. Battling the competitive advantage of being able to start afresh versus living with the challenge of adapting legacy processes remains a challenge for many. But data on its own is not enough. Analytics, machine learning, and artificial intelligence are needed to drive data insights. Margins continue to be squeezed, just as the need for analytics and insights to find alpha continues. Risk management and optimizing the customer experience are more than ever important. Financial institutions who understand that they are really data businesses will be better placed to solve these challenges. Consider some of the biggest companies on the planet. Alphabet, Apple, and Facebook, they're essentially data companies. The sooner financial institutions recognize that data strategies will drive their business performance, the better. A focus on internal data sets, often not even seen as data sets, can often yield benefits and greater insights than the relentless search for new external alternative data sources. According to research by State Street, 88% of global fund managers see cross-border data distribution as a major headache. Data management practices are clearly holding back business. The increasing volume, velocity, and variety of data available, coupled with the insatiable desire for data to feed digital, data science, and analytics strategies, makes this challenge even more acute. Add to that the increased operational and supplier risk borne by sourcing multiple untried data sets from multiple sources, and you have some hard questions regarding risks and returns. The chief data officer, the data scientist, and the business leader all understand that insights are more valuable than the data itself. But the rush to explore new data sets is hampered by the sheer lack of coherence across data. A lot of this data is new, in different formats, untried and untested. It isn't exactly Lego, as any data scientist will tell you. From MiFID II to PRIPS, all regulations require the production of numerous documents needing to be collected and updated. And it feels really anti-digital to add yet more documents to the process. The workflow certainly isn't getting easier. A range of regulations such as SFTR and CSDR have only increased the need to distribute data and documents that are not easy to get hold of in the first place. And data protection rules differ greatly across the globe, and yet major international financial institutions operate globally. Global organizations with global IT stacks, global data management functions, navigating regional regulations and local jurisdictional interpretations creates a recipe for increased complexity. When it comes to data, it's not just that there's more of it. The differentiation in the licensing models, coupled with the challenges of auditability, regulatory oversight, and lineage, overlay yet more barriers to automation and digitization. Data models need to constantly evolve. Digitization needs to crack this very heart of the data management challenge. Yet with all this focus on automation and digitization, there are some hard habits to break. I struggle to believe that we still do not have globally consistent, machine-readable bond prospectuses, for example. So complexity clearly pays somewhere in our industry. Supplier risk for data is a board-level issue. Data underpins financial, operational, and reputational risks for a financial institution. At this pivotal point in the history of our society, the financial industry needs to be a force for good. With prominent geopolitical, health, and economic risks, shareholders and customers seek opportunities for growth in new business models, while using the reference points of today to provide the stability, clarity, and certainty to navigate. Blending the new with the traditional is key to this transformation. A great example is the opportunity presented by alternative data, but it only means something if you can connect it with your present reality. In adopting new data sets and technologies, a financial institution has to be grounded in high-quality data governance, excellent reference data, and increasingly, a large dose of common sense. SIX is uniquely positioned to help. Not only do we have the unrivaled broad-spectrum expertise in all aspects of wholesale and retail finance, with the accompanying know-how when it comes to compliance, risk and regulation, but we have already invested in the technology and solutions needed to transform today's markets. We believe the future of finance is now. Thank you very much for listening.